Hey guys, welcome to another educational content piece from myself, Ricky Jack at Creative Real Estate. The topic for today is looking at rental growth and expense growth and comparing two scenarios, one in which we have steady rental growth and steady expense growth, with rent growth being above expenses. The second scenario, which has been a little bit more true to investors over the last 2 or 3 years, is a faster than expected expense growth and a slower than expected rental growth. So let's dive right in. So we've got a $10 million purchase price, a loan of $6.5 million, about 60% loan to cost or 65% loan to value rather. The additional cost is coming from, as per usual, all of these things add up on a transaction. I always find it quite funny when we compare things to purchase price instead of all-in cost, because only one is true, and that is the all-in cost. So, what you'll notice over here is we've got the senior loan processing fees. So people got to get paid when you do debt. We've got a renovation budget of about $220,000. It's actually $200,000, but we've got 5% for contingency and an additional 5% for the contractor possibly working on that if it's not us, which gets us to the 220 total. In this case, we've just assumed that there's deferred maintenance on the property. So we're not doing like a value add with that renovation or anything of that nature. It's just assuming deferred maintenance, which means that we have no additional rental bumps expected as a result of that renovation. It's really just making sure that the property stays in a good leasable condition for the residents. So the other costs that we have there is due diligence, closing costs, the acquisition fee, and our operating reserve. So all of those things come together. Operating reserves is something that typically you would fund up front, and you should get it back at the end of the project if everything goes according to plan. But life doesn't always go according to plan. So I almost have that in there in this model, and in most of the models that I do in particular, as a bit of a buffer. So we kind of assume that all-in costs will get absorbed over the next 5 years. You know, the base case or the most hopeful case, let's say, is that we get all of that back out at the end of the project, because it's really meant to be a reserve. You're not supposed to spend it. But typically speaking, life happens. So in our models, we prefer to just absorb that cost during the life of the project and assume that it's gone. So hopefully, we're wrong and we can pay a high return. But if we don't, then at least we're being conservative going into the numbers. What I want to draw your attention to, which is more important really, is taking a look at our expense growth. So what we have right now is we've got the rental growth running over here and the expense growth running just below it. We've got it moving from 3% on the rent growth, a steady 3%, and we've got a steady 2% on the expense growth. And you might ask yourself, well, why are they different? And that is a good question. Should they be different or should they not be different? Historically, rental growth has typically exceeded expense growth, but in the last 2 to 3 years, that hasn't been true at all. So we'll get into what that looks like shortly on the next model. But for now, let's stick with this assumption. Just to answer your question, part of the reason for that is because housing demand tends to outpace supply over time, and that's why it doesn't just stay in line with typical inflation. It's slightly above inflation. But each market's completely different. Each market has different supply and demand factors driving it. This is really just talking from averages. So for the sake of this exercise, to keep it simple, we're going to keep it just like this. And I think that is what most syndicators would like to see and believe that we will live in a world which operates with higher rental growth than expense growth. So what you'll notice over here is the gross rents are growing. Year 0 to year 1 is slightly different just because this was originally based on a real deal. So there's some nuance there. But what you'll notice is from year 1 to 2, year 3 to 4, year 5 to 6, all of them are 3%. All of our total controllable expenses are moving up at 2%. Our non-controllable expenses are moving up at slightly above 2%. The reason for that, if we were to pay a bit of attention, is on the annual cash flows, our management fee grows at 3%, doesn't grow at 2%. And the reason is because our management fee is linked to our revenue. So our management fee is always typically linked to revenue. And as a result of that, we can't keep it at 2%. I mean, we could do it artificially, but it's not real. So we didn't do it that way. So that's the reason that it's slightly higher than normal. And what you'll see is blended, it works out to 2.06%, which is really around 2%. So I think that's fair to say. And what we have here is, you'll notice we have what you could deem, return and expense growth leverage. So our NOI growth is above our revenue growth. And the reason for that is because our expense growth is lower. So you have kind of this outpaced growth on the NOI side relative to the revenue, because our expense assumption is low. So you see this plotted out nice in the chart here. You see how our NOI grows in dollar value, and then you see our NOI growth over here, and it kind of plateaus and comes down somewhat, but it's really just kind of hovers around that 3.8%. Okay, as a result of this, take note of our returns. Deal level returns, we got almost 20%, 2.26 multiple, 6.93% cash on cash. So that is scenario one, and that is a scenario that we all kind of hope and pray for, and have a great time when it does work out like that. Unfortunately, over the past two, maybe 3 years, specifically since COVID's hit, we've had some interesting market dynamics which have thrown the market a little bit crazy. At first, we had super high rental growth, way above 3% in most markets, and we had expense growth kind of in line. And thereafter, following the next 2 years, we had a scenario where it sort of reversed quite drastically. And as a result of so much new supply coming to the market, demand almost stayed. Demand didn't come down. Demand actually has done really, really well. But as a result of so much supply, rental growth kind of stagnated. In many markets, it's actually gone down. That was one scenario that played out, is rental growth sort of stayed flat and came down. And then we got this massive shock to the system on insurance. Taxes in a lot of markets went up quite drastically. And as a result of that, we had way higher than 2% expense growth. Repairs have gone up, contractors' costs have gone up, payroll's gone up. So many of these different things have gone up quite drastically. And that resulted in a scenario where instead of having higher rent growth and expense growth, the majority of the market really had higher expense growth than rent growth. So let's have a quick look at how that would affect a property deal. Exact same deal, exact same scenario playing out here, so I won't go through the deal breakdown again. But if you're following with us on the screen, you will see that the rent growth is now at 1%, which is, let's say, friendly to some markets. Some of them have been coming down quite drastically as a result of so much new supply going into the market. But just generically speaking, rental growth has come down drastically, if there's growth at all. And then on the expense growth side, expenses have gone up. So let's have a look what happens over here. We've got a similar scenario shaking out, where our controllable expenses are now, instead of higher, they're coming out slightly lower. And the reason for that, as I mentioned, is our management fees linked to our revenue, and our revenue is now lower than before, not higher. So that is why our effective non-controllable expense growth, and non-controllable expense in this case, we are taking into account management fees. So that's the reason that it looks like that. And our total expenses then works out to 2.89%, okay, as annual growth, which is close to 3%. And our income growth and rental growth stays at 1%, which results in a year-over-year NOI decline. No growth. No, what's going on? That sucks for us as landlords because it essentially means the property is losing value every single year by 1%, moving in the wrong direction. And you can see this in this chart on the bottom left over here, and then this one over here on the NOI growth. And you can see how it continues to deteriorate and just get worse and worse and worse. So hopefully something's got to change. Now pay attention to these returns on the right here. You've got the deal level IRR is now 9%. You've got the deal level earnings multiple 1.47. And the only reason at all that this is positive is because we've bought this property. We've assumed to have bought this property at a really healthy cap rate of something like 6.5% is a yield on cost, or probably close to the 7% yield on cost. And then we are assuming that we can exit at 5.5%. But if we bought this property at 5.5% and we're exiting at 5.5%, we'd be in a serious problem. So that IRR return would be non-existent. We'd be losing money. And I think it's a pretty vague picture to have to face. Now, where this becomes really dangerous is these kinds of dynamics can play out over 1 or 2 years. That does happen in life, but eventually, because of supply and demand factors and the way that it works and the way that development cycles work, this will reverse again at some point in time. The risk is, can you hold on for that point until that point in time when it will reverse? And to illustrate this, I want to go across to our annual cash flow sheet over here. And first, we'll start with the annual cash flow for our positive rental growth, or both are positive, but a higher rental growth and a lower expense growth. And we'll move to the bottom and we'll pay attention to this line. This is our debt service cover ratio. It should actually say interest cover because the one below is debt service cover, which includes principal payments or amortization. And what you'll see here is we go from 1.2 times, which means that we have 20% more income than we need to service our debt. I know it says 1.19, but 1.2 is fine. And then it goes to 1.24, and then it goes to 1.3, and then 1.34, and then 1.4. So in 5 years' time, instead of only having 20% of the income, more than the income than we need to service our debt, we have 40%, which obviously means we're in a better position. We're more comfortable. We're not worried when we have some random expenses that show up on the property because there's enough of cash flow available to still service our debt. Now, unfortunately, if you can't wait long enough for the market to reverse and you're stuck in a situation where your rent growth is well below your expense growth, then it starts to look a little bit ugly. So let's see what that looks like on the annual cash flow. Okay, if I go to our annual cash flow here, you see in this scenario, out the gate, we're starting low at 1.16 times. So there's a very good chance, unless it's a HUD loan, you probably won't even get debt on a property like this if that's the assumption in the first year, because your debt service coverage ratio typically needs to be at least 1.2 times. In pretty liquid debt markets, we're in rather dry, illiquid markets now, so most of them are most likely requiring 1.25 to 1.35 times. That aside, what you'll notice is things just continue to get worse. It goes from 1.16 to 1.15 to 1.13 to 1.11. And if you were lucky enough to get a loan, you're going to be in a position pretty soon where you've got some huge issues. Now, let's see what happens if we make some adjustments there quickly and did things a little bit more drastically, sort of as we've seen occur in the market somewhat. All right. So now, as you can see, this is dropping drastically. You've got some negative returns showing up here. You've got 0.83x, which means that if you put in $1, you're going to get 83 cents back. Kind of scary situation to be in. And then if we go to our annual cash flows, you'll see our debt service cover ratio just drops off the map. And essentially what happens in this scenario is you'll go into foreclosure. The lender's going to come take the keys from you as the landlord, and you've got a serious problem. So you can see why what's going on in the market has some fundamental influence on what's going to happen to you as a landlord and to your property. And you can see immediately what a large impact higher and lower rent and expense growth can have on a property. So I hope that you found this valuable and insightful today. There's actually so many more things that pop into my mind while I'm sharing these videos that I'd like to delve into, but we're way over time already. So if you found this valuable, give me a like below, comment below, let me know if there's anything different that you want to see, or some mistakes that you think I made, or something that I missed that we should include in the next video. Thanks again for tuning in. We'll see you soon. Cheers. Thank you.